Let's talk a little bit more about Treasury supply, the bond market, because we've already seen little glimmers of that, right? At a time when the Fed is cutting, very unusually, 10-year and 30-year yields are going up.
If you're a homeowner, maybe a home buyer, you're probably asking the same question. You're like, okay, the Federal Reserve, they keep cutting rates, so shouldn't mortgage rates come down? Well, in today's video, we're going to talk about that. I'm going to give you a sneak peek to my 2026 mortgage rate forecast. But what I want to talk about today, with really not a lot of economic news coming out this week, is the bond market. And this is a great interview to segment right into where our mortgage rate forecast is for 2026. So if you're new to my channel, you have to understand how mortgage rates are created. They're actually created by a bond. So folks, my name is Dan Frio. I come in each day because I want you to understand what's going on with mortgage rates and the real estate market. So today we're going to talk bonds. I know it's not the sexiest thing, but you have to understand these if you really want to understand these over through here. Because folks, my name is Dan Frio. Like I said, I'm actually a federally licensed mortgage loan officer. I'm licensed in all 50 states as well as Puerto Rico. My goal each day is to come and explain to you guys what in the heck's going on with those and the whys behind it. Today is going to be Bonds 101. Where the bond market's going to take us in 2026 is basically where rates are going to go if you're a homeowner or home buyer. So let's get back to the interview, take a little bit of a deeper dive into that, and then when we come back, I'll put it in layman's terms for you folks, and I'll explain to you guys how it has a role in these and the whys behind it. So without further ado, let's get back to the interview.
We've seen little glimmers of that, right? At a time when the Fed is cutting, very unusually, 10-year and 30-year yields are going up. So is that a sign of things to come next year, that we could see more of that phenomenon in the bond market, especially with more Treasury supply coming to market?
So there's tremendous supply from the public sector and from the private sector. Data centers now alone are going at a rate of 150 to 175 billion a year in terms of debt issuance. That is big. Then you have a 6% of GDP deficit. That's big for this part of the cycle. What I worry about is at some stage the bond market is going to say, you know what, we're not pricing in risk the way we should be pricing in risk.
So if you're a little confused on what he was just talking about, he was talking about the bond market and kind of how it works. So if you're trying to figure out what's going on with these, you have to understand the bond market. So let's get over to it so I can explain the components that he was talking about, where my expectations are in 2026, and we'll take a deeper dive into it so you understand what's going on with these and why. So let's get over here. Here's what we focus in on every day. We focus in on this. So if you're new to my channel, this is what we focus in on every day. At the top there, it says MBS. That means mortgage-backed security. It's a mortgage bond. So the yield on this thing makes basically up your mortgage rate. Okay, so how you read this is if that number goes up there, that means mortgage rates are coming down. We love when the market goes up. If you look over there over the last 3 months, mortgage rates haven't really moved at all. And we've had the Federal Reserve cutting rates. So why aren't these things moving? Well, it's intriguing because you have to go over here. Here's what the Federal Reserve looks at. Okay, so let's rewind back to beginning of the year. Remember where we had tariffs come into place and everybody's like, okay, that's going to be a massive increase in inflation and that's going to cause the unemployment rate to spike. Okay, that was 6-8 months ago. Okay, so a lot of that data has been compiled into here and we haven't really seen a major shock here. But the Federal Reserve's sitting there saying, okay, we're waiting for these to kind of the shoe to drop on one of these, inflation and the jobs numbers, but they haven't really hit there yet. So my expectations for next year is going to be based on the supply and demand of bonds. So how do I think that's going to factor in next year? Well, let's get over to it. So here's what we look at each day. We go through the economic numbers and everything else. Here's my thought on this. Okay, so let's get back to mortgage rates. When we focus in on this, we focus in on where inflation's taking us, where the jobs market's going, and where our debt is and everything else. So let me just give you a sneak peek of what my forecast is going to be later this week. So we have inflation. Well, we know it's been sticky. It's over 2%, but it's not running rampant like a lot of analysts thought it was going to be. Remember back when tariffs hit, they're like, okay, this could bring inflation back to all the way where we were beforehand. It's 7-8%. Well, inflation now is, let's get over to what do we look at. Inflation's right now is at 2.8. So it's below 3. They want this at 2, but it didn't really skyrocket. But then the analyst said, okay, now the jobs numbers are going to be completely dismal. Well, if you watch ADP, they're dismal. But if you watch a lot of other analysts, they're coming in saying, okay, maybe it's not so bad. So now the dilemma here is the Federal Reserve sitting in between here saying, okay, inflation's still high, but it's not going crazy. The jobs market's some signs are good, some signs are bad. What do we do? Well, then they go over to the national deficit. They're saying, okay, how much debt do we have? And that's where all this comes into play. One big piece of the puzzle they came in recently at the Federal Reserve's last meeting when they cut, they came in and said, we're going to do something interesting. We're going to come in and start quantitative easing again. We're going to start buying back bonds. So when you're looking at all this stuff, where's mortgage rates going to go in 2026? Well, I'm going to give you my 30-day and maybe my longer forecast now, but I will be out later this week to give you my whole 2026 forecast and the whys. But let's get over and take a little bit of a deeper dive in this week and then what some thoughts are. So this week, we're supposed to maybe get the PCE tomorrow and also durable goods, the GDP. Okay, so then on Wednesday, we're hoping to get the initial jobless claims. This is going to fill a role in some of the gaps that the Federal Reserve monitors and the markets monitor as well. But with a holiday week, you're probably going to have a lot of people on vacation. New York Stock Exchange, the bond markets are going to be limited trading. So, we might see a huge volatility. We might see really nothing happening this week. So here's my thoughts on what's going to happen. So if you're closing within 30 days, folks, just lock in. Don't worry about it. Don't have a heart attack. Don't be frustrated through all the holiday season. But if you're closing later than 30 days, okay, so let's get to that section. Again, like I said, if you're closing within 30 days because we have basically a lot of the holidays hitting us in the next 2 weeks, don't worry about it. Just lock in and put the heavy lifting on us. What do I do? What do I do for a living? Well, let's get over to this. If you're a homeowner right now, we can help you out tremendously. What rate would you be interested in refinancing? Well, put it in right through there. So I created a RateWatch tool right up through there. All I needed to do is plug in your mortgage information and put in what rate you'd be interested in refinancing. We don't sell the data, folks. We don't share it with anybody. Yours truly will probably be calling you. But wonder if you're looking to maybe buy in the spring. You're like, okay, I'm going to get my tax refund money. I don't really want to mess around with the holidays. But come January, February, March, I'm going to be looking for a house. Well, what should you do? Maybe you're looking to build. Well, let's go to my section where we call lock or float. So let's get to that section right through here. So if you're closing within 30 days, folks, just lock them in. Don't worry about it. Don't fret through the holidays. But if you're closing over 30 days, maybe 120 days or further, just float. Just float. Reach out to us and go to our website right through here and get pre-approved. Okay, make sure your credit score is optimized to the maximum it can be. Do you even know what your credit scores are? I bet you don't. Okay, so what income also can be used to provide you a pre-approval? What is your budget? How much are you really looking to spend? Can we meet that budget and put you into a program that makes sense? Okay, so these are all the things that we can do for you. So if you're looking to build or buy next year, reach out to us. Put in your application. Make sure you get a consultation with us so we can walk you through all the parts of the puzzle, pieces of the puzzle, so you understand the mortgage process. So let's get back to recap these things for today. I know we went all over the board. Folks, I don't really think mortgage rates are much, things are going to really do much at all this week. If we go over to the bond market right now, it is down 8 ticks. That really doesn't mean anything. The markets aren't really going to move off of 8 ticks. So the markets are going to be flat today. If we do get the economic news out tomorrow, such as the PCE, and then on Wednesday, the jobs reports, it could move the markets. So now let's go over to see how the stock market's doing. So if you go to this, it's a pretty good day across there. I'll call this the Cinderella story -1. What do I mean by that? Well, I call it the Cinderella story right through here. When I have the Dow Jones, the S&P, and the NASDAQ all up, and we have oil down. Well, we don't have oil down, but it's below $60 a barrel. Why do we follow this? Well, this helps us give it a bead on where inflation's going, because oil has a huge piece of the puzzle when it comes to inflation. When oil's below $60 a barrel, it helps out tremendously. We have the U.S. 10-year Treasury, it is up just a little bit. Let's go to cryptocurrency. Whoa, we got cryptocurrency back at $90 a coin. So that is, I'll say, folks, this is a Cinderella story. So where are rates going to go from here the rest of the day? Well, join me later today at the closing bell so I can inform you guys what the heck went on with those and why. So thanks for watching, folks. If you're new to my channel, please subscribe over there so every time I post a video, you get an alert. It might just be something that interests you and you might be able to learn something. If not, skip it. I'm sure there'll be something down the pike that interests you. So thanks for watching. Again, my name is Dan Frio. I'm the host of the Rate Update. I'm also a federally licensed mortgage loan officer. I'd love to help you navigate home ownership or looking to make that home a little bit more affordable with a refinance. Reach out to us. We'd love to help. Thanks for watching. See you later. Bye-bye.